Hello and welcome to our channel. If you're new to investing and want to learn how to invest in stocks, then you've come to the right place. In today's video, we're going to guide you through the process of investing in stocks in a comprehensive, step-by-step manner. So, grab a cup of coffee, sit back, relax, and let's dive into the exciting world of stock investing. To kick things off, let's start with the fundamentals. The stock market might seem daunting at first, but once you understand the basics, it's much more approachable. So, what is a stock? Well, a stock represents a share of ownership in a company. When you buy a stock, you're essentially buying a small piece of that company, and you become a shareholder. As a shareholder, you're entitled to a portion of the company's profits and any voting rights attached to that stock. Another term you'll frequently come across is market capitalization, or market cap. This refers to the total market value of a company's outstanding shares of stock. It's essentially a measure of a company's size and helps investors understand the scale of a company relative to its peers. Companies can be classified as large cap, mid cap, or small cap, depending on their market cap. Next up, let's talk about the stock market indexes. These include the S&P 500, Dow Jones Industrial Average, and the Nasdaq Composite, among others. These indexes are used as a proxy to track the performance of the overall market or a specific segment of the market. They help investors understand the market's overall direction and health. Understanding these concepts is critical as you embark on your stock investing journey. Now, let's move on to the next step. The first actual step to investing in stocks is to determine your budget. How much money are you ready and willing to invest? If you're a beginner, it's usually a good idea to start with a smaller amount, such as $1,000 or even less. This way, you can gain some experience without risking too much of your hard-earned money. One important thing to remember is to invest only money that you can afford to lose, meaning you won't need this money for living expenses or emergencies in the next few years. The stock market can be unpredictable, and while it's a powerful tool for wealth creation, it's not without risk. Additionally, before you start investing, it's a good idea to build up an emergency fund. This should cover about 3 to 6 months of living expenses, and it provides a financial safety net in case of unexpected costs or circumstances. Now that you've decided on your budget, the next step is to open an investment account. This is where you'll hold your investments. There are two main types of investment accounts you could consider: a brokerage account and a retirement account. A brokerage account is a taxable account that allows you to buy and sell a wide range of investments, including stocks, bonds, ETFs, and mutual funds. They're versatile and easy to set up, which makes them a popular choice for beginners. On the other hand, a retirement account, such as an individual retirement account, IRA, or a 401k, offers significant tax advantages that can boost your long-term savings. However, these accounts come with specific rules and restrictions, especially regarding when you can withdraw your funds. It's important to evaluate your investment goals, timeline, and tax situation to determine the best type of account for you. If you're uncertain, consider speaking with a financial advisor who can provide personalized guidance based on your circumstances. Once you've decided on the type of account, it's time to choose a broker. A broker is a financial institution that facilitates the buying and selling of stocks and other securities. There are two main types of brokers to consider: full-service brokers and discount brokers. Full-service brokers offer comprehensive services, including personalized advice, portfolio management, and access to in-depth research. However, their fees tend to be higher, which might not be ideal for beginners or those with a smaller investment budget. Discount brokers, on the other hand, are more cost-effective. They typically offer online platforms where you can manage your investments yourself. While they might not provide the same level of service as full-service brokers, they often offer educational resources and tools that can help you make informed investment decisions. When choosing a broker, compare their fees, the services they provide, the user-friendliness of their platform, and their customer service reputation. This will help you select the broker that best fits your needs and comfort level. With your account all set up, it's time to roll up your sleeves and start researching stocks. This can seem a little overwhelming at first, but here's a tip. Start with companies that you're familiar with and understand. Being a consumer of their products or services can give you insights into their performance and potential. Here are a few steps to guide your stock research. Understand the company. Look at the company's business model, products or services, competitive position, and management. This information can typically be found on the company's website or annual reports. Look into the financials. Examine the company's financial statements, including the income statement, balance sheet, and cash flow statement. You're looking for consistent revenue and earnings growth, a healthy balance sheet, and strong cash flow. Evaluate valuation metrics. Use ratios like the price-to-earnings (PE) ratio, price-to-sales (PS) ratio, and price-to-book (PB) ratio to assess whether the stock is undervalued or overvalued. Read analyst reports. These reports can provide valuable insights into the company's prospects and the industry's trends. Keep up with news. Follow news about the company and its industry. This can help you identify potential opportunities or threats. Remember, diversification is key in investing. Instead of putting all your eggs in one basket, try to spread your investments across various sectors and companies. This can help reduce risk and increase your chances of earning a solid return. If picking individual stocks seems a bit too daunting or time-consuming, you might want to consider exchange-traded funds, ETFs, or mutual funds. Both these options allow you to buy a basket of stocks with a single purchase, providing instant diversification. ETFs trade on an exchange just like stocks, meaning you can buy and sell them throughout the trading day at fluctuating prices. Mutual funds, on the other hand, are priced once a day at the market close. While both options have their pros and cons, they can be a great way for beginners to get started in the stock market. They allow you to invest in a diversified portfolio without having to analyze and select each individual stock yourself. Once you've done your research and decided what you want to invest in, it's time to place your order. There are a few different order types you can use, but we'll focus on two main ones: market orders and limit orders. A market order is an order to buy or sell a stock immediately at the best available price. On the other hand, a limit order allows you to specify the maximum price you're willing to pay or the minimum price you're willing to accept. A limit order will only be executed if the stock's price meets or betters your specified price. Consider the stock's volatility and your own investment strategy when deciding which order type to use. It's also crucial to review your order before submitting it to ensure all the details are correct. Now that you know how to place an order, let's talk about formulating your investment strategy. Your strategy will act as your guiding principle in managing your portfolio and making investment decisions. Here are a few popular investment strategies. Dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the stock's price. This strategy can help mitigate the impact of market volatility and remove the emotional element from your investment decisions. Dividend investing. This strategy focuses on stocks that regularly pay dividends. Dividends can provide a steady income stream, and they can be reinvested to buy more shares. Growth investing. This approach involves investing in companies that are expected to grow at an above-average rate compared to other companies. Growth investors are usually less concerned with dividends and more focused on capital appreciation. Value investing. Value investors seek stocks that they believe are undervalued by the market. The idea is that the market will eventually recognize the company's true value, at which point the stock's price will rise. Remember, there's no one-size-fits-all strategy in investing. You'll need to consider your financial goals, risk tolerance, and investment timeline to find the strategy that works best for you. Once you've made your investments, your job isn't done. You'll need to monitor your portfolio regularly to ensure it's still aligned with your investment goals. Stay updated on market news, economic events, and any changes in the companies you've invested in. This will allow you to make informed decisions about whether to hold, sell, or buy more of a particular stock. It's also important to rebalance your portfolio from time to time. This involves adjusting your portfolio to maintain your desired level of asset allocation. Rebalancing can help manage risk and keep your investment strategy on track. Last but certainly not least, it's essential to be patient and remain committed to your investment strategy. Investing in stocks is generally a long-term endeavor. While the stock market can be volatile in the short term, it has historically provided positive returns over the long run. Avoid making hasty decisions based on short-term market movements. Stick to your plan and stay focused on your long-term goals. Remember, it's not about timing the market, but time in the market that matters. And there you have it, folks. We've journeyed through the ins and outs of stock market investing together. It's been an exciting exploration, breaking down the entire process from grasping the essential concepts. Setting up a financial plan, opening an investment account, selecting a broker that suits your needs, all the way to strategically selecting stocks and formulating an investment strategy tailored to your personal financial goals. Remember, this video isn't just a one-time watch. As you progress through your investment journey, feel free to revisit this guide and refresh your knowledge. We've aimed to provide a comprehensive overview that will serve as a long-term resource for you. We trust that this step-by-step guide has empowered you to confidently step into the world of investing. And as you embark on this journey, patience and perseverance will be your best friends. The stock market can fluctuate, but maintaining a long-term perspective is crucial. Stick to your plan, keep your eye on the long-term prize, and remember, the objective here is not to become rich overnight, but to build wealth steadily over time. Before we say goodbye, if you found value in this video, please give it a thumbs up and consider subscribing to our channel. This way, you won't miss out on the wide array of financial education content that we continuously roll out. If you have any questions or if there's a particular topic you'd like us to cover in a future video, feel free to drop a comment below. We're always excited to engage with our community of viewers and respond to your feedback. Thank you so much for your time, for investing in your financial education by watching this video. We're looking forward to seeing you again in our next video.